Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague, Lawrence Gillum. We put equity strategy and fixed income strategy together. You got a pretty nice blend. How are you today, Lawrence?
I'm doing great, Jeff. Yeah, looking forward to the conversation. Lots to talk about today.
Oh my goodness, is there? Cross currents, needless to say. Um, I don't know if there's an analogy between what I felt in my home office this morning and the markets, but we actually had an earthquake in New England and I felt it. I believe that's the first time I've ever really felt an earthquake. I mean, once like they had one in New England like 12, 13 years ago. And I recall maybe feeling that a little bit, but it was a stretch. This one I really felt, even though it wasn't as big as that last one. So crazy stuff. A lot of folks on social media didn't know what it was because they're rare around here. Have you ever felt an earthquake down there
I
by you, Lawrence?
I have not, but I guess it just continues that string of crazy weather. I mean, the Florida Panhandle got 10 inches of snow last week or 2 weeks ago or whatever it was. So crazy things are happening out there.
Yeah, no doubt. It is crazy and the markets and the news is a little bit crazy here as well this week. Just when you thought you could celebrate a second straight really strong up week for stocks, we were greeted Monday morning with a sharp sell-off on this um, DeepSeek China AI tool that has shown the efficacy that's even better than some of the models, the AI large language models that we have in the US. So we'll talk a little bit about that. But that doesn't take away from the fact that the stock market's done pretty well so far this year. We'll talk about what the bond market's telling us about inflation next. I mean, it's more than just inflation, but it's also what are the credit markets telling us. So glad you're here, Lawrence, to do that, because I can promise you I would have struggled if I was doing it without you. Next, earnings update. It's a pretty good start to earnings season, but not a lot of upside. Still, I would argue that it's pretty good considering the headwinds. And then finally, preview of the Fed. Yet another reason why I'm excited to have Lawrence here with us for the fixed income perspective. So it is Monday afternoon, January 27th, 2025, as we are recording this. The tech sector is down almost 6%. The S&P 500 down almost 2%. So no one cares that we had 2 good weeks in a row. People care about where we're heading next or where we're going now. So we'll be quick with this recap, but I think the market came into last week and the Trump inauguration thinking we were going to get tariffs on day one, and we didn't. So, that was certainly one tailwind. I also think, Lawrence, that lower rates were a little bit of a tailwind. They didn't move sharply lower, but they moved lower last week. And I think that put some support under equities. Then lastly, and this is reversing today, of course, is the AI trade, right? This Stargate AI joint venture with Oracle and SoftBank and OpenAI with 500 billion in capital investment. I think it's over 4 years. That is a really big chunk of change, and certainly got the markets excited about tech last week. So you see, comm services up 5, tech up 3.5, and then some. For the most part, even industrials has a little bit of AI in it, which is hurting it today. Industrial is quite strong with a 3% rally, and in general, not across the board, but in general, the riskier sectors did better than the defenses, and you had a growth led week. Internationally, our international markets did pretty well. Actually, Europe is at a new all-time high, or at least it was at the end of last week. So seeing a little bit better performance there. Still, it doesn't really stand out so much relative to the U.S. Up 5.9% year to date. That includes this morning versus the S&P up 3.8. So yeah, a little bit better, but that's kind of it's a short period of time, obviously. And then Japan had the rate hike as expected. Lawrence, I don't know if you think that maybe had something to do. Some are drawing a conclusion that the carry trade is tied to the Nasdaq. I get it. So do you think that the news out of Japan, even though it's late in the week, had anything to do with the risk on trade last week?
Yeah, I think it certainly contributed to a certain extent, but I think your opening commentary was spot on. Just that there was this expectation for universal tariffs being applied or levied across all these different countries that didn't come to fruition. We saw a rally in the rate market because of that. That there was a lack of just tariffs implemented. So I think there was a couple of good reasons why markets were higher last week. But as you mentioned today, that narrative has shifted a little bit.
Yeah, we had the carry trade driven sell-off in the US equity markets back in August. That was over an 8% drawdown. Maybe the market was to an extent kind of relieved
Yeah.
that we were prepared for what we got from the Bank of Japan and we didn't have much of a reaction. So here's your page. At least most of this page is yours, Lawrence, the bond market. So we had a pretty good week in bond land.
Yeah, so it was a positive week, which has been few and far between within the fixed income market since September, or the end of September, rather. Treasury yields have just generally moved higher. Last week, we got some relief. As I mentioned, it was partly because of the no new tariffs that were expected by markets. Certainly there's been a lot of discussion about tariffs, and I think bond markets were pricing in the Trump administration applying tariffs pretty liberally, but that hasn't happened yet. We'll see if it actually does happen. I think the other reason why rates were lower is the Treasury Department has hit its debt ceiling. It's hit its debt limit, so there's no new additional Treasury issuance out there. Now they can refinance existing debt, but the Treasury stock is going to stay at the same level now. So there, all these concerns about supply demand dynamics coming out of the Treasury Department with all that Treasury supply coming to market to fill those budget deficits. I think last week was a reprieve. This week, another one of those reasons why we're seeing lower rates. We'll get into this week, I'm sure, as well. But nonetheless, it was a good-ish week for fixed income markets. The ag up about 10 basis points. The investment grade corporate index up about 30 basis points. Plus sectors continue to do well. So you got the high yield bond market up about 50 basis points, up about 1.2% this year. I was looking at spreads earlier. So spreads represent the additional compensation for owning riskier bonds versus Treasury securities. And despite the big sell-off in the equity markets, we really haven't seen credit spreads move too much. And we're going to talk more about that in just a second. But that's been an area of the market that has just been overly resilient, regardless of what's going on in the world. So high yield bonds up 50 basis points last week. And then, preferred's up about 50 basis points as well. So 0.5%. So pretty good market for a lot of the fixed income markets. Mortgages, it's an area that we have an overweight in our discretionary asset allocation models. Didn't really participate. So that one's a little bit disappointing, but by and large, a pretty good week last week in the fixed income markets.
Yeah, maybe fixed income like the lower oil and gas prices last week. You see here, crude down 4%, natural gas down almost 6%. And I was reminded today that Europe has much more expensive natural gas than we have, right? In fact, over triple. Japan plays a lot more for natural gas too. So, maybe US exceptionalism is under attack a little bit if China's a little ahead in AI today. And it's not just that the model's more powerful, it's that it's cheaper and requires less power to train. That's what is disrupting the markets in the US today. But our exceptionalism is partly also related to cheap gas and our energy efficiency, right? Our independence, energy independence that we developed over the last 10, 15 years with the shale boom. So that's a really big deal and can help us with the inflation problem and can help us keep rates down. So beyond that, the dollar was weak last week because this includes this morning's trading too, by the way, because of the tariffs, right? If If rates go up on fears that tariffs are inflationary, and if you're pricing in a trade war, you're probably going to have a higher dollar. Well, we got the opposite. That trade kind of unwound, and then the yen, of course, got some support from the higher rates from the Bank of Japan. So here's the S&P 500 chart. Now this includes the sell-off today, and you see here we still are holding the 50-day, and all these moving averages are trending higher. So we really haven't done technical damage today. We'll see if the sell-off continues after we get a little more information. But for now, the positive technical picture is intact. Now, we've been saying for a while, and this probably won't change much today, we'd like to see more stocks participating. We'd like to see a higher percentage of stocks above the 200-day. Right now, it's about 62%. So we'll keep watching that, but that sort of adds to the reasons to think we might get a little bit of a pullback. Obviously, we're getting it today. Could go a little bit further. We've been saying for a while that sentiment is stretched and we need to maybe cool off a bit. So, this sort of AI news should, is a catalyst certainly for the start of a sell-off. We're already seeing that today. There are other reasons why maybe it could continue a little bit longer. And by the way, that puts the January effect at risk. Because we're, after today's trading, depending on how we close, but probably only be up 2% for the month. And, that means you just got a little less cushion to end the month positive. And remember, the stats historically are really compelling. If you have a positive January, on average, your years are up 17. If you don't, you pretty much, low single digits, I believe, is the number. So, that'd be something to watch too. So the Mag 7, of course, a lot of AI in here. So I threw this chart in. Here it's actually kind of the same story, a little worse, but kind of the same story, that we're still in an uptrend. This group has been doing so well that just one big down day doesn't necessarily break your positive momentum. So here again, we are barely holding the 50-day. And, we haven't quite broken down. The top panel is absolute prices, bottom panel is relative strength. And you see here, even the relative strength line is still holding above recent highs. And, right on the 50-day, but maybe a tiny bit below it. So we still got a little bit of a cushion. And if, these stocks stabilize tomorrow, they're all different. But if they stabilize tomorrow and throughout the week, the story, I don't think, will be one of technical damage. It'll be one of just sort of hanging in there and passing a test. So we'll see how that goes. I think it's also worth noting, cheaper AI models are good for the U.S. economy, right? Not just good for China, because and less power requirement allows us to get to that productivity boom more cheaply. In fact, maybe that's why you're seeing shares of Meta up today. So just keep in mind, actually Apple too, if the cost of this and the power of it levels up, we're just that much closer to actually getting the benefit of this. So it's not all negative. All right, let's go to bonds. And Lawrence, the 10-year is really close to breaking down here. What do you see on the 10-year chart, and how do you think the economic data is affecting that?
Yep. So we are around 453 as of now. So we have had a pretty decent rally since the middle of January. To your point earlier, January 15th, 14th, something like that was the most recent peak. We hit around 480 on the 10-year Treasury yield. So, we're down, almost 30 basis points over the past couple of weeks. Along that same time period, oil prices are down about 10%. So it's been a nice relief from oil prices, these inflationary pressures. The economic data has kind of been okay still. So we haven't seen the economic data fall off. Last week was a pretty light economic data week as well. This week's going to be a busy one, which we'll talk about later. But, this has really been kind of just an adjustment of less Treasury issuance, fewer tariffs, or the tariff scare behind us. So we'll have to see how the Treasury market reacts this week with GDP and PCE and all these other acronyms that are going to come to market this week. So, but it's been a good run. Our view is that we still think we'll end the year lower. 375 to 425 is our year-end target. So we're a quarter of a percent away from kind of just getting that back into play. I still think that 480 was the recent top. I do think that we could probably retest that sometime this year, just given the stronger economic data and just the deficit issues aren't going to go away right away. So I think that's going to be a headwind for long-term Treasury yields falling much from current levels. I'm hoping Doge and these other things work out and we're able to reduce the deficits. Certainly that'll help the Treasury market, but that's not going to be a first half of 2025 solution. So I do think that over the course of the next 5 months, 6 months, we could retest that 480. But right now, I think it's there's a nice tailwind to yields going on right now, though.
Yeah, I think it was a little easier for the leader of Doge to cut costs at Twitter than it will be to cut costs for the federal government.
For sure.
So, though we're all rooting for the U.S. government to be more efficient and to get closer to getting its fiscal house in order. That is a decades-long project, but hopefully over the next year or two we can start making some progress, and I think we'll see some of that progress later this year as we get into reconciliation and negotiating the extensions of the tax cuts and all that. So let's move along. So Lawrence, you did the weekly market commentary today, which is available on LPL.com under the research tab, and it is about essentially the messages from the bond market about inflation, or frankly, the economy. I would argue in terms of the credit market. So so let's walk through your charts here. What are the key takeaways?
So we're all about market signals here on the Market Signal podcast.
Hey, how about that?
So looking at a couple of the different market signals coming from the bond market, I mentioned earlier that the 10-year Treasury yield is about 1% higher, despite the fact that the Fed started cutting rates back in September. That doesn't typically happen. You tend to see rates either stay where long-term Treasury yields stay where they are, or even fall. But the recent backup in Treasury yields, I think, has some folks concerned about the bond market expecting a resurgence of inflationary pressures, and that is not what we're seeing right now out of the fixed income market. So what we're showing here is the 5 and 10-year inflation expectations, so market implied inflation expectations. And yes, those inflation expectations have increased recently, particularly since the Fed started cutting rates back in September. But we're not back to levels that would suggest markets are overly concerned about a second resurgence in inflation. I think that the point I'm trying to make here is that we were in a very low inflation regime post global financial crisis up to pre-COVID, and that was an era that was really characterized by low growth, low inflation, low interest rates. And as we get back to what I'm calling a more normal market environment, that it's the normal market environment is pre-global financial crisis, not pre-COVID. So, the markets, I think, are expecting inflation to stay around the Fed's 2% target, which is good news for the Fed. Because remember, in that low inflation regime, the Fed and a lot of other officials were concerned about disinflation or even deflation. And that was a bigger concern for markets and for Fed officials. So if we can get inflation back to around 2% pretty reliably, I think the Fed would take that, and certainly the bond market would take that as well. So good news, at least initially, despite the concerns about tariffs and a pro-growth administration. Markets aren't, the bond market anyway, isn't really concerned yet about inflation running away like it was earlier in the year, or earlier back in 2022.
Yeah, I mean, I guess we've had a little bit of an uptick. That University of Michigan survey, a tiny bit of an uptick in inflation expectations lately, but we're ready to get some pretty good inflation numbers, right? The the year-over-year comparisons get a lot tougher over the next several months. We've talked about this with Jeffrey Roach, right?
Yeah.
So you're going to get some pretty decent looking year-over-year inflation numbers over the next several months, and maybe that can, help again anchor in inflation expectations.
Yeah, for sure. It's we get the PCE data this week. I think the PCE data and the CPI, the Consumer Price Index, that those are. I mean, you're getting similar type stories about inflation maybe plateauing for a little bit, but the PCE data that we get this week, I think, should be a relief to fixed income markets. I think it's supposed to come in, close to 2% on a year-over-year basis. So I think markets would welcome that. So, it's just that CPI data and that lagging owner's equivalent rent component, which I'm sure Jeff has talked about as well. So, but right now, the good news is that the bond market is not overly concerned about these additional Trump administration policies pushing inflationary pressures significantly higher from current levels. So that's good news for Fed and for consumers.
Yeah, and you can look at that 2017, 2018 period when tariffs went in during Trump's first term, and there's not much, right? A little bit of a uptick, but it kind of stayed in its range.
Yeah,
actually even lower than in the period coming out of the financial crisis a few years earlier than that. So yeah, maybe that market's realizing that too, and that's helping the markets deal with this. So you just said, Lawrence, that the market's not really that concerned with inflation. The market's not that concerned with this little bit of an uptick we've had in bankruptcies lately either. The spreads are tight.
Spreads are tight. So we're looking at investment grade and high yield corporate spreads. So that, again, that additional compensation for owning riskier debt. Spreads remain at or near secular tights. So despite wars and inflation and maybe a pickup in some bankruptcies and defaults, the credit markets really haven't moved much. I mentioned today that even despite the equity markets selling off pretty significantly, spreads are wider by about 5-7 basis points. So not really a big move higher in spreads despite what's going on in the equity markets. So we tend to look at the credit markets, and they can act as this canary in the coal mine. Returns for credit markets are pretty asymmetric, meaning there's a lot of downside potential, whereas your upside scenario is you get your money back plus some, your coupon. So you can get really burnt by owning some of the riskier credits in the market. So we pay attention to those credits. They tend to be a sell first, ask questions later type market, and we just haven't seen that sell first type scenario out of the credit markets. Now, I write in the weekly market commentary that we do still have all-in yields that are really attractive for a lot of institutional investors. You think about these pension funds, these other endowment funds that have, call it like a 7 or 8% return target every year, where you can buy high yield bonds to a certain extent, but a lot of investment grade bonds and just hold to maturity, and you get most of the way there to your return target without a lot of the volatility. So institutional investors have been playing a key role in keeping spreads tight, but that said, we're just not seeing any sort of concern from the credit markets from inflation or from bankruptcies. The spike that we saw in 2022 on that bluish line there, that really was a result of those inflationary pressures that peaked around 9% for the CPI. So you do tend to see a reaction out of credit markets when inflation is higher than expected. So that we haven't seen a move is another reason why bond markets anyway aren't concerned about a second leg up of these inflationary pressures.
Yeah, the regional banking crisis in early 2023 didn't look like it had much of an effect either.
Right.
So, yeah, pretty battle tested, I would say. And certainly this, AI sell-off is not going to spark concerns in the credit markets too much because who leads AI? It's the Mag 7. Who has the strongest balance sheets with the most cash? The AI, these companies don't need to borrow.
What's amazing, is Apple is a big issuer. NVIDIA is a big issuer in the market, but Apple, not a recommendation at all. But if you look at some of their debt, they're their debt is actually trading inside treasury yields. So their
Mhm.
yields are lower than the US government because of their fortified balance sheets. And, investors would rather own a 2-year Apple paper than versus a 2-year treasury security. So they're not impacting the credit markets from a negative perspective at all. Those are actually some of the reasons why spreads have remained tight because of those solid balance sheets.
Yeah, and again, there's a sort of second derivative effect of this AI news today, which is lower costs, right? Immediately, the knee-jerk reaction is sell off because, the demand opportunity is reduced for the big AI names in the US because, China might be a fiercer competitor than we had anticipated.
Yeah.
If it slows down CapEx because there's more scrutiny on the returns of these investments, and maybe those returns aren't quite as good as market had thought. That's what we're going to sort out in the coming weeks. Sure, that's negative. But if you take the cost down and you make something more powerful for a lower price, you know, that's a win.
Yeah.
So, not
What's
for
interesting
Nvidia maybe, but
What's
that's
interesting about that, though, is
a win.
your comment is absolutely perfect, because what we're seeing in the Fed funds market is the expectation of the Fed cutting because of the disinflationary impulse coming out of this DeepSeek release. So you're absolutely right. So if costs do come down, that means the inflationary dynamics are going to improve as well, which means the Fed can cut rates more than what was expected. So that's one of the reasons why we're getting a rally out of the rates market right now, is
Yep.
the expectation that the Fed can cut rates because of the fact that AI just got a little bit cheaper from this DeepSeek release.
Absolutely. Very interesting. So yeah, when I came in first logged onto my machine, it was 10-year yield down 8-9 basis points. So market recognizes this pretty quickly. Last chart in your weekly commentary, Lawrence. I guess maybe the tagline here is tips are interesting.
Yep. So the takeaway, the so what, is that bond markets aren't concerned about inflation, but if there are investors out there that are concerned about inflation shocks, TIPS, Treasury Inflation Protected Securities, are offering pretty attractive yields. So TIPS are Treasury securities that the principal it adjusts based upon the inflationary environment that you're in. So if inflation is above what markets are pricing in, your principal increases and you actually earn more than what your starting yield is. So right now, tips are offering around 2-ish% inflation adjusted. So to kind of compare that to a nominal treasury, for example, if a 10-year tip security has a 2% yield, and you say if you think inflation is going to be, call it 3% over the next 10 years, the comparable would be a 5% nominal treasury yield versus what you're getting out of tips plus your inflation assumption. So we talked about the bond market not really pricing in concerns about inflation, but markets can be wrong. So if you do want to have an inflation hedge in portfolios, tips are pretty attractive right now, we think.
Very good. Overall, still like bonds, still recommending fully invested fixed income in our portfolios and fully invested neutral on the equity side as well. So tips may be an interesting idea to put in there for those do-it-yourselfers out there. Let's turn our attention to earnings. So, this is going to be a huge story this week too. We also get GDP in the Fed, but and everybody's trying to figure out what this DeepSeek news means. But I think the key thing to keep in mind here with earnings is that there is a pretty big currency drag here that companies really didn't expect a few months ago. And so the upside we've seen that this far, actually, I think is pretty impressive. So titled this section, Earnings Objects May Be Better Than They Appear, kind of take off on what you see in your rearview mirror. And, we've gotten good upside. We've got already about a point. So we were kind of looking at high 11s consensus coming in. Now we're about 80 companies in. So about 16% of the S&P has reported, and we're tracking to almost 13. 77% of companies have beaten bottom line targets. That is a good percentage. However, we've seen estimates come down about 0.5% since companies started reporting. So that doesn't sound great, but when you consider the currency effect in there, it's about 1.5 points, give or take, on growth from the stronger dollar. And you consider all this trade uncertainty, probably makes sense that companies would be a little bit cautious. And by the way, I know that Q1 guidance, so what you give in Q4, tends to be the most conservative. So this is kind of a time to lower the bar so you can, beat it for the year. So all those factors considered, these results are pretty good. We've seen, great results out of financials. We talked about that last week. When the banks reported 2 weeks ago, we've seen pretty good growth out of tech and communication services, and which we expect to continue because, of course, DeepSeek doesn't affect Q4 results. So all in all, pretty good earnings season. Now this week is a big week. We get 4 of the Mag 7 reporting. Hope I can list these off the top of my head. So it's we get Tesla. Help me out here if I forget one. We get Meta. We get Microsoft and Apple.
That's
I think
right.
I got that right. Nvidia's later. It always is. Amazon's later next week, and Alphabet's later next week. So that right there, just those 7 names is about 5 points out of the 13. So that's a really big deal. But the rest of the market matters too, right? So that's the other 8 points. And those companies can certainly chip in, and we're going to get a lot of different companies this week. So, we'll probably get more of the same, not a ton of upside, but modest upside as we predicted, and we'll get, a little bit of currency drag. And then from these AI names, we're going to get questions over and over and over again about the China AI model. So, anything to add to that, Lawrence, or should we go to the preview of the week?
No, the earnings cycle is interesting because I correct me if I'm wrong because I'm not an earnings person, but I think Nvidia's earnings aren't for like another month, right?
That's right.
So there's a lot of time between this DeepSeek release and any perhaps commentary on or from Nvidia. So it's exciting. I mean, I'm a fixed income person, so I like watching paint dry, but the what's going on in the tech world is pretty exciting.
Yeah, how about that? Much more exciting than paint drying or grass growing or any of that stuff. So you're you can come on over to our side anytime, Lawrence, if you want a little more entertainment. So
I don't know if I can handle that, but we'll see.
yeah, well, I have an earthquake today, so maybe I can handle volatility more than most. Thankfully, not big enough to do much damage, although it originated out of Maine. So I haven't seen news on any impact in Maine, but if it's an under 4, it's probably not going to do much, if any, damage. Thankfully, we've had enough weather disasters, as you alluded to. So let's preview the week ahead in terms of the economic calendar and the central bank calendar. We kind of already previewed earnings, but I would point out that we get about 100 companies from the S&P 500 reporting. It's not just the Mag 4 or whatever you want to call them, Fabulous 4. It's companies all over the place, and that right there, I think it's 20% of the S&P 500 this week, but it's over 30% of the earnings that are reporting this week. So really, really important week for earnings. What else should people be watching, Lawrence?
Yeah, here in the US, it's Fed week, so it's probably, I may jinx myself here, but it probably won't be as exciting as the December meeting. The December meeting, remember, we got this hawkish rate cut where the Fed cut rates by 25 basis points, but then said, pretty much that was going to be it for a while. Very low expectations coming into this Fed meeting. That's on Wednesday when we get their decision. Only about a 0.5% chance of a rate cut. So market expectations are pretty low. So hopefully this is a pretty calm market environment after the meeting. The one thing that I'll be paying attention to, though, is that we haven't really talked about quantitative tightening or balance sheet runoff. So maybe this is a meeting where they provide some additional commentary on that. But again, hopefully this is going to be a pretty quiet Fed week. which isn't always the case. We also have the ECB and the Bank of Canada this week, where they're both expected to cut. So we're going to continue to see that divergence between central banks outside the U.S. and the U.S. So there could be some impact in the currency markets, but hopefully, relatively quiet elsewhere.
Yeah, we've been talking about how the ECB is going to cut while the Fed kind of waits for a while. And that probably is part of why European equity markets have done better lately. I mean, that's not enough. You need more. And frankly, we might be getting more. Maybe the market is pricing out tariff risk in Europe as it pertains to the US and the Trump administration. Those markets are breaking out to new highs. So I'm glad you pointed that out, Lawrence. We'll certainly watch the ECB and watch expectations, because they don't really have maybe the UK does, but they don't really have a rates problem so much anymore. They don't really have a big inflation problem so much anymore, because you don't really have the growth over there to spark inflation like you have over here. So anything else to add on the week ahead, or did you cover it?
Well, I mean, the other thing that you have highlighted is PCE. You have your headline in your core, still around 2 something. So that's
big number.
Probably not going to move the needle in terms of market expectations. I think it's pretty well, priced in at this point, where we're going to be at these kind of levels for a couple more months before we see progress towards the end of the year. I think that's what I think Jeff had. Low 2s at the end of this year, and then 2 into 2026. So it's unfortunately it's not going to be a problem solved right away. But if the bond market is correct, we shouldn't expect a second resurgence in inflationary prices. So we still think we're going to get back down to that 2% target eventually, perhaps early next year.
Yeah, so if you get frustrated watching the kind of stubborn PCE inflation data, just switch over and watch CPI, because CPI is actually going to show some nice improvement over the next several months on a year-over-year basis because of the base effects. So yeah, better inflation data there. It won't be the end all be all for the Fed, but it'll help a little bit on the margin with markets. So yeah, good. Maybe better news to come there. So thanks for that, Lawrence. We got a lot to pay attention to this week, needless to say. It's one of the busier economic calendars and central bank calendars that you'll ever see. And then on top of that, you've got earnings, and we all got to figure out what DeepSeek means. So in fact, probably be one of our main topics for the podcast next. So thanks, Lawrence, for jumping on. Really good stuff on the bond market. I'm glad that the bond market's offering us some reassurance that we can point to that, on what is a challenging day for the equity markets here on Monday. Everybody have a wonderful week, and thanks for listening to another LPL Market Signals. We'll see you next time. Take care.